Hello everyone, welcome to today's session. So today we are going to continue our chapter number 3 that we have discussed in the previous session. We will continue that. Okay. Now, before I continue further, before I continue the next topic of the chapter number 3, I would like to ask you whether you have any doubt till now, whatever we have discussed on the chapter number 3, any doubt with respect to any of the part. Anyone? Any doubt? If you have doubt, please uh, ask as much as you can, because that will really help you guys to understand the topic in much more detail. Discussed about SA 620. Can anyone summarize SA 620 that we discussed yesterday? If you guys have no doubt, then I think you will be able to discuss or able to summarize SA 620 that we discussed. Come on, quickly. Anyone?
Hello.
Yes.
Yes, sir. Good evening.
Ah.
Sir, in SA 620, we discuss about the essay using the work of an auditor's expert. So, in this
Mhm.
work will be included like outside the work of accounting and auditing, means some
Mhm.
expertise kind of work, such as the IT specialist, IT related, and auditor's expert means they will be expert of certain kind of field related to IT and so on. So IT specialist or valuation specialist, they will be considered as a auditor expert.
Okay, great. Yes,
And
very
objective of
good.
auditor in this is like he has to determine whether the work of auditor expert need to be taken, and he needs to check whether that work is adequate for the auditor to give the opinion or not. These
Okay,
also we are discussed.
okay, very good. Yes, very good. Okay, so anyone would like to add to this anything? Anyone? Okay, not an issue. Perfectly, very good answer. Yes. Now, second thing I would like to ask: can we refer the auditor's expert in our audit report?
We can refer only in case of if there is qualification in the report, means if there is no qualified report, means if it is unmodified report, then we do not need to refer. If there is qualified report, then we will refer, and if it is required as per law, then also we need to refer. Otherwise cases not need to refer.
Yes, very good. Yep, absolutely correct. Good. So yes, you can only refer to the auditor's expert in your report when either you have a modified opinion or if it is required by law. If it is a modified opinion, you need to state that it does not reduce your responsibility as an auditor. Okay. So you need to make sure that you refer to that particular part, that it does not reduce your responsibility as an auditor. Okay. Now we will take one question, and then we will discuss about that particular case scenario. Small simple question that we have on the topic that we have already discussed. Okay. Let me. Okay. So here is the scenario. You are the engagement partner at KRG and Associates, Chartered Accountant, appointed as an statutory auditor of Horizon Manufacturing Limited for the financial year 24-25. Horizon Manufacture is a large entity with operations spread across multiple locations, and the processes as well as restores internal audit function. The IEF reports functionally to the audit committee and administratively to the chief executive officer. Okay, so we are talking about internal audit function. During the planning phase of audit, you are evaluating the possibility of utilizing the work of IAF, that is the internal audit function, to enhance the audit efficiency. Now, the IAF has recently conducted a detailed review of the operating effectiveness of the internal controls over the procurement and payable cycles. You are considering relying on this review. Furthermore, due to extensive nature of the HML's operations, you are also considering utilizing the internal auditors to provide direct assistance to your audit team in the following areas: observing physical inventory count at various locations, evaluating the assumptions used by management in impairment and testing of goodwill, performing test of details on high volume travel expense claims. Okay. Now, with specific reference to SA 610, detail the considerations and responsibility of KRG and associate in this engagement. Specifically address the following. First, what criteria must the KRG and associate evaluate to determine the adequacy of the internal audit function itself before deciding whether their work can be used? So we will go question by question, one by one. First, I would recommend take a minute, read the case again, and then we will take up the questions. So take a minute, read the question, and then we will discuss the question number one with respect to the what criteria they must be evaluating. Okay, I hope you guys have read the question. So, what criteria must KRG and associate evaluate to determine the adequacy of the internal audit function itself before deciding whether their work can be used? Come on, guys.
Sir, in this, the work which has been done by the internal auditor, in that external auditor will check OCA. That is, first O is objectivity, second C is competence of the internal auditor, and third A is approach, means what is the approach towards that work. So this OCA will be followed in case of the work which is done by the internal auditor, and the work which is yet to be done. So in that case, external auditor will give guidance like how it needs to be done. In that, only OC need to check. That is objectivity and competence. Approach will be given by the external auditor.
Okay, very good. Yes. Very good. Absolutely correct. Anyone else would like to add to this particular point? No? Okay. If no, then tell me one thing. When I talk about competency, status, how you will check that? How you will check that particular point? If I want to evaluate these things, how will I do that?
Sir, for checking competence, first we will look into professional competence, like what professional qualification internal auditor is having, and
Mm-hmm.
second thing we will see like what is their approach of work, means how detailed they have worked on. That
Hmm.
will see what level of observation they have raised. Those all things, by reviewing it, we can understand what is their level of competence and what is their team member in internal auditor.
Okay, yes, very good. But apart from that, like one part is the competence, the competency. Second is the organizational status. How will you validate that? How will you validate that particular part?
So can you explain like what organization status you are asking, means
So when you will analyze the, like whether you need to have this particular internal audit function to use their work, before that you will evaluate them now. So evaluation can happen only on evaluation will happen on three areas. Number one is your competency. Number two objectivity, and number 3 is the organizational status. Okay, so we call it as an OCA, organizational status, competency, and objectivity.
Okay.
In that case, like, how will you check organizational status here? Objectivity, for objectivity.
We will check like internal control means what internal controls organization has kept in, and whether that control are being followed appropriately or not, whether there is any control place regarding prevention, detection of any misstatements and all those
Okay,
things we will check.
okay. Anyone else? Yes, very good, Chitra. See, remember we discussed when we discussing the example, at that point in time, we discussed that in order to determine whether we can use internal audit function or not, we need to check few things. I'll take you back to that particular example. So this was the example that we were discussing. Okay. So first I need to check organizational status with respect to the relevant policies and procedures, whether they support the objectivity or not. We checked about the competency, and then we check about the approach, OCA method. Okay. Now here, to check the organizational status and objectivity, we will see to whom they are reporting. Who is the person who decides the scope for the internal audit, like what they have to audit. Third, with respect to the findings of the internal audit, reporting, to whom they are reporting, whether they are able to directly share their findings, is there any pressure on them, what is their KPI with respect to, is there something performance bonus, or is their salary, or their pay dependent upon clean reports. Remember we discussed this kind of example. So when I talk about objectivity, there are factors for which we need to evaluate whether any of the given factor is impacting their objectivity. And trust me, the standard itself has given a very good examples when it comes to the factors that may affect. For example, if I'll take you to the, even if you read the standard, it has given excellent examples. Okay. For example, whether the internal audit function is free from any conflicting responsibilities. For example, managerial, operational duties or responsibilities that are outside internal audit function. For example, is internal audit function reports to those charged with governance or an officer with an appropriate authority or not? Whether they have a direct access to those charged with governance. Is there any undue influence on them, conflict of interest on them? Is there any overriding professional judgment? So there are few examples which will help you to determine, or few factors I would say rather, which will help you to determine, like, is there any constraint on the internal audit function which can points toward impaired objectivity, like what standards they follow when they perform the internal audit. For example, to the chartered accountants, you have a code of ethics applicable. Even in the, we have seen in the professional ethics that even when you are in the employment, code of ethics is applicable. There are schedules already applicable. So even in the employment or members in general, to them, code of ethics is hello. Am I audible?
Yes, sir, you are audible.
Sorry, I think there was some glitch in the network. Okay, so what I was discussing basically is that these are the factors that can help us to decide whether there is an impaired objectivity or not. Okay, and accordingly, basically, you say that okay, objectivity is there or not for a particular internal audit function. I hope I'm clear. So you will check OCA, that is objectivity, competency, and the approach. And when I talk about even approach also, approach is kind of the thing how they are auditing, how they are selecting the scope, what sample they are selecting, what are the areas or the methodology for the risk assessment. So these are the things, like as I said, OCA is something that you need to check for before deciding whether you can use their work or not. Any doubt? Any doubt? Nope. Okay, great. Now, second, assuming the IAF is deemed adequate, sorry, you assume that it is deemed adequate. Okay, what specific audit procedures must KRG and associate perform on IAF reviews of the procurement and payable cycles to determine if their work is adequate for the external purpose? Now, they have done some work on the procurement and payable. You want to use that work. What you will check? You want to use that work. How and what you will check? Anyone? Come on, come on. What you will check to understand, like whether their procurement and payment cycle work is adequate for your purpose or not. No? No one? Okay. No issues. I'll take you back to the discussion where we discuss about this particular point. Before deciding whether you can use their work or not, you need to check OCA. But once you check OCA, after that, you need to make sure that the work which is performed by them is adequate for your purpose. Okay, we need to check the adequacy. And remember, there were certain areas where we thought, okay, no, we will not give them any work. Yes or no? So, what were the areas? Areas were Jericho. For example, judgment, evaluation, risk of material misstatement, uh, where the organizational status is creating issues, where the competency is lower for them in a specific area. So over there, we will not give them any work. And for the work that we are going to use, we will check by this way. That is PPS, whether they have planned, performed, how they have planned and performed the work, supervised the work, reviewed, okay, sufficient and appropriate audit evidence, conclusions reached on that particular work. Remember, we discussed an example. Let's say, for example, I'll take you to that example only. This one, scenario 1, scenario 2. We discussed whether this is adequate for our purpose. Scenario 1, where they tested 10 crores. Scenario 2, 25 crores. Remember, we discussed about the scenarios, like which scenario is adequate for the external auditor. And based on the external auditor's requirement, we came to a conclusion that scenario 1 was adequate. Why? Reason because our risk was with respect to the, let's say, cutoff. And in that case, the testing one, which was scenario testing one, which was done, was adequate. Now, let's say, for example, we also discussed that, let's say, they have tested one sample, first one and last one. And the first one was earlier failing, then they passed it. So we talked about the conclusion, whether the outcome of testing is tying up with the conclusion or not. For example, the sample was being failed just because they got an explanation from the management about provision, like, about that invoice was received late. They cannot pass the sample. They cannot change their conclusion. Sample was failing, so the conclusion should be failed also. Okay. So accordingly, we decided no, conclusion, planned, performed, sufficient and appropriate audit evidence are certain things that we need to understand before we can say, okay, their work is adequate for our purpose. Clear? Any doubt? So PPS, sufficient and appropriate audit evidence, and appropriate conclusions. Yes, very good, Chitra. Any doubt with respect to this one? Any doubt with respect to this question? I'll go back to the question. Okay, objectivity, competency, and approach. And here I will mention for you it is PPS, sufficient and appropriate audit evidence, and the third and most important part is about the appropriate conclusions. Okay, I hope you guys are clear with this. Okay, now there are three areas which are given over here: observing the physical inventory count, evaluating assumptions used by management in impairment testing of goodwill, and performing test of details on high volume travel expense claims. Now, the third question is analyze the proposed area 1, 2, and 3 for utilizing direct assistance. Advise which areas are appropriate and explain the limitation on prohibition under SA 610 regarding the nature of work that can be assigned as a direct assistance. So, which are the areas out of these three you think will be appropriate, like, to give to them? We can take a direct assistance from them. Which are those areas? Come on, guys.
First and third give, sir.
First and third, okay. Anyone else? Point number third, okay, very good. Very good, Mega. First and third, Chitra. Yes, very good. Okay, so basically, see, when I have to assign the area for the testing or for the direct assistance to the internal auditor, the thing I need to make sure is to understand is, Jericho, remember, those are the things that I cannot give them. Okay. If that area is basically involving a high judgment, I should not give to them. Okay. Now in first, it is in your inventory count, which is not a judgmental based. Physical inventory count at remote locations. Okay. Over there, if that area is not having higher risk of material misstatement, I can allocate because it does not involve judgment. Second, evaluating the assumptions. Now, this is the area where it could be, we could have a higher assumptions. And for the higher assumptions, we cannot. If I go back to the areas that we discussed is more judgment, which is involved in planning and performing. More judgment is involved in the evaluating audit evidence. Higher risk assessed of misstatement, higher risk of material misstatement, where the organizational status is not supporting the objectivity, where the competency is low. Now see, when I talk about physical verification is you don't have a more judgment. It's a procedural work where they need to verify the existence of the inventory. Like if it is there in the records, it should be there on the ground. If the inventory is on the ground, it should be there in the records. Less judgmental. Unless and until you are coming to the valuation of the inventory. Valuation is something different. I'm talking about physical count. Valuation is separate part, physical count is separate part. So physical count, perfectly fine, provided there is no higher risk of material misstatement, because which is not given in the question. You need to assume it. Okay. Second, assumption and impairment of the goodwill. Now, this is the area where more judgment is involved because of the assumptions. We will see in SF5 now. So I cannot give. Third, it was related to travel expense claim. Again, it is not something where you need a more judgment. It is not a higher risk of material misstatement because travel expense. The volume is high, but the amount is not. Perfectly fine. I can give 1 and 3, but I cannot give 2. Okay. So based on that, I can give 1 and 3. I cannot give 2. Simple. Any other doubts? Any doubts to respect to these question number 1, 2, and 3? Okay. Now the last one. If KRG Associate utilizes the internal audit for direct assistance, what are their responsibilities concerning the direction, supervision, and review of the work performed? What they need to do? If let's say for tomorrow they come up, okay, fine, let's use them. What is their responsibility? Before taking their assistance, what you will do? So I'll write it here. Areas not to give. Okay. Now, again, fourth point. What you will do before you assign the work to them? Before you, like for example, if you decide, okay, fine, it is not the difficult area which we are giving to them, 1 and 3. Before they start working on 1 and 3 point, what is your responsibility? Come on, guys. What is your responsibility with that? Before they start working on 1 and 3. Anyone?
Sir, we need to, like, external auditor will give the approach, like how the internal auditor will conduct the audit. Like he will give the direction. Suppose inventory count is done, so how he need to done counting of the inventory. Those direction will be provided to the internal auditor and their team as well.
Yes. What else? Okay. So when it comes to the using the work, actually, what is the responsibility? Basically, there are two responsibilities that we have discussed: agreement, DSR. DSR is nothing but direction, supervision, and review. Okay, this is the DSR. One is before you do a direction, supervision, and review, there is an agreement. Agreement means you need to obtain agreement from management that they will not interfere. That is, not to interfere. Okay, that they will not interfere in the work that we are assigning to them, and they will do it, because you need to take the permission. Now you cannot go and directly say to internal audit, okay, let's start work. You start work on that. No, we have to take permission. We have to obtain from management that they will not interfere. Yes, very good, Mega. Second, we need to ask internal audit function to provide the confirmation on confidentiality. Okay, we will say them, okay, boss, one, you will not, first, management will not interfere. Second, you gave us a confirmation that there will be, you maintain the confidentiality. An agreement that, okay, you will keep matters confidential as and when we will provide you. Okay. So you will say them about the confidentiality. You will basically ask them to maintain confidentiality. So these are the two agreements that you will do. Plus, you will provide an overview of planned approach as part of your audit plan to those charged with governance. Remember, audit plan we have seen, it was given that we will use the internal audit in this particular area. You need to give that. Then comes the direction, supervision, and review. For the direction, supervision, and review, yes, you are absolutely correct. You need to provide the approach. You need to provide. So you need to explain them the NTE, nature, timing, and extent of the procedures they need to perform. Second, you need to review the work. Why we need to review the work? What is the reason why we need to review the work? Quickly.
To check the adequacy of the work, means whether the work is adequate for our requirement or not.
Okay, but we need to also review the work as per SA 220. Reason because SA 220 says that auditor, external auditor, engagement partner is ultimately responsible. He has to issue the opinion. So whosoever is doing the work for you, you are still responsible. Review the work. Remember in SA 220 and SQC 1, we talked about review supervision also. Yes or no?
Yes, sir.
So over
Yes,
there,
sir.
engagement partner has to review the work that is being performed by the team or anyone he has appointed for the audit. Similarly, if internal audit is doing some work for you as a direct assistant, they will be counted as a part of your team for that particular purpose. You have to review. And third one, very important, always remember IAF is not independent. They are not independent. Reason because they are employees. At the end, you need to make sure. So you have to be, always alert when you are reviewing their work. There are chances they are not independent. So there you don't expect independent. The work that you need to review it. Let's say, for example, your team member, they are independent. Okay, if you review their work, you will review accordingly because they are your teammates. But if there is an internal audit who is performing some work for you, you need to make sure that whatever you are reviewing with a alertness, skepticism. So these are the things that you need to make sure with respect to DSR. Clear? Any doubt? Any doubt with respect to any of the part?
Sir, there will be one agreement or two, like one with management and one with internal auditor also. There will be two or one only.
Usually there is one agreement where internal auditors are also, aware about the see, at the end, internal auditors are working on the direction of management. If
Yes.
internal auditor is a third party, which is hired by the management, at that point in time, you need to have a separate agreement. And a lot of complexities are involved when you sign an agreement because you need to see what agreement exists between the internal auditor and the management. If it is an employment agreement, whether the employment agreement contains a clause through which you can, ask them to work for you in the case of direct assistance. If that employment agreement is shallow drafted, then again, it creates a problem. You need to have a separate agreement. If the employment agreement is properly drafted, it contains all the relevant clauses, fine. If they are the third party consultant, what agreement they have with the management, what clauses they have with the management. So all those things you need to understand before you sign an agreement with the management and or with the internal audit. Any doubt? Any doubt with respect to any of the area that we have discussed? No? Yes? No doubt? Clear? Okay, very good, great. So if no doubts, let's proceed ahead with the rest of the topic that we need to discuss for today. Okay, so what we have discussed till now is we started with the audit plan program strategy. We went through SA 600, 610, 620. Now we are going to discuss one very important standard, that is accounting estimate, auditing of accounting estimate, including fair value accounting estimate and related disclosures. See, when I talk about accounting estimates, why it is a very important and relevant topic? Reason, because it is present everywhere. When you talk about financial statement, a lot of estimates are there. A lot of estimates. Some are very critical. For example, going concern, very important. For example, goodwill related impairment estimates. A lot of assumptions are there. So when you are testing the estimates, you have to make sure that these estimates are appropriate. Okay. So here we will understand what is the responsibility of the auditor when it comes to the auditing the estimate. Okay. Before I deep dive and start discussion on auditing the estimates and all that particular part, I just want to first discuss on the terms which are relevant over here. First is an accounting estimate. Can anyone tell me what is an accounting estimate? Can anyone tell me what is an accounting estimate over here? See, once you understand what is accounting estimate, then we will talk about auditing it. But let's first understand what is an accounting estimate. Anyone?
Sir, it is a kind of like a provision for bad debts management creates. So that provision amount is decided by the management, which is judgmental, which is
Yes.
not any aspect calculation. Just it is based on management's judgment only. It is decided.
Yes, absolutely correct. So it is decided based on the judgment, where you don't have the exact amount. Yes or no? Where the
Yes, sir.
accurate amount cannot be determined. Absolutely correct. Absolutely correct, Mega. Where you require a judgment. Yes, very good. So when I talk about accounting estimate, it is an amount where you cannot measure it appropriately. That's why you are doing an estimate. Okay. So if you are not able to measure that amount appropriately or specifically, precisely, in that case, you make an estimate. Okay. Now, when I say you cannot estimate the amount, or when you cannot, like identify the amount precisely, when you cannot identify the amount precisely, over there, you make an estimate. Now, with each and every estimate, there is a term which is attached, or there is a thing which comes into the place, which is estimation uncertainty. Okay, what is an estimation uncertainty? That the accounting estimate, okay, that the accounting estimate or the disclosure which is there lacks the precise or the exact nature in its measurement. Simple example, when I talk about accounting estimate, over there, I say that it is It is an amount which is not measured precisely. That's why you are making an estimate. Now, not measured precisely means making an estimate. This is the estimation which you are doing. With this, it comes an estimation uncertainty. This estimation uncertainty means that when I see estimation is something that, okay, you are making an estimate, but when I add something more, uncertainty, that means it lacks precision. Now you will say, sir, we know it lacks precision. That's why we are making an estimate. If we had the precise data, why we will make an estimate? Yes or no? So when I say estimation uncertainty, that means there is a lack of precision while making the estimate. But your next question should be, sir, we know there is an uncertainty. We know that's why we are making the estimate. Perfectly fine. Yes, absolutely correct. That's why we are making the estimate. So with each and every estimate, there is an estimation uncertainty involved. Clear with this? What is an estimation uncertainty? There is an inherent lack of precision in its measurement. That it is there from the start. That's why it's an estimate. You cannot, separate both. Okay. So one thing we understood is with each and every estimate, we have an estimation uncertainty involved in it. Okay. Now, what difference does it make? Why should we worry about estimation uncertainty? Now, when there is an estimation uncertainty, when there is a lack of precision, there is one big thing that we need to take care of. Okay. That is one big thing that we need to take care of. Let's say, for example, I will explain with an example. Let's say there was a litigation. We don't know the liability. How much will be the penalty? We don't know. Penalty amount, we cannot confirm. Based on the litigation, we cannot confirm. So we thought, okay, let's make an estimate. We made an estimate of rupees, let's say 500. For now, let's keep the numbers very simple. We made a penalty amount estimate of 500. This is an estimate. Now, simple, see, this estimate, this 500 is based on something like someone might have thought, why 500? There should be something behind it. It should not be a random number. Okay, random number table. I'll select, okay, 1, 2, 3, 4, 5, 500. Let's say 500. No, there is just something, some logic behind this 500. Okay. Now, when I talk about this logic, or some, instead of logic, I will use the term base. There is a base behind this estimate. Base behind estimate, which is your, you can say, provision. In this particular case, penalty provided in the provision. Penalty provided in the provision. Okay. Now, I took the penalty which is provided in the provision. Okay. And accordingly, I made an estimate. Fine. It is reasonable. Okay. I could say it's reasonable because you have considered based on provision. Now, let's say tomorrow, if I take 50%, if I add this thing, 50% of penalty provided in the provision, I'm taking half of it. Now, the problem comes is, this is uncertainty I'm talking about. That means here I am deviating, I am, lacking behind the precision. The precision here was provision, amount that is provided in the provision, but this 50%, if I'm taking half of the amount, That's a lack of precision. And this lack of precision is due to why? Why there is a lack of precision? In this particular case, if I ask you a question, why do you think there is a lack of precision? Let's say this is a management decision. So management has taken this decision to take 50%. Now my question is why there is a lack of precision in this case? Anyone?
Sir, at least 100% penalty amount provision should be made, because
Yes.
if there is, and due to that reason, there is lack of precision.
Absolutely correct. But if I talk about why not 100% taken? Management decision? Yes or no?
Yes, sir.
So I can say there is a lack of precision because of management decision.
Yes, it is a management decision, lack of precision. Yes.
There is a lack of precision because of management decision. Now here the lack of precision here. Lack of precision is due to management decision. When this happens now, lack of precision due to management decision, at that point in time, I call it as a management biasness. Management is biased towards showing 50% of the amount, lesser amount. Okay, so management is ready to show lesser amount. Management is biased towards showing lesser amount. They are not going to show 100% of the penalty. They are only showing 50%. So the estimation uncertainty gives rise to the management biasness at times that we need to understand. Are you getting the point? So when I talk about management bias, it's a lack of neutrality by management in the preparation of the financial statement. Here, management is not neutral. They should have taken 100%, but they took 50% of the penalty only. So they are not neutral. So when I say there is a lack of neutrality in the preparation and presentation of the information, it's a management biasness. Clear? Any doubt? Okay. If no doubts, perfectly fine. Not an issue. Now we need to understand. See, these were the few things that we understood. Now we need to understand that how you will audit accounting estimate, because few things are already clear. What is estimation uncertainty? What is management biasness? It's already clear. So it's now easy to understand how we will audit this. Let's say you are there on the ground. You need to audit this litigation penalty provision or the estimate. How will you audit that? How will you audit this?
Sir, in this case, we will check, like, as per the law, what is the penalty amount, and whatever is the penalty amount, so we will ask the management, like, why there is this provision amount created for only 50%. In this manner, we will audit this transaction.
Okay. Very good. Yes. Absolutely correct. Yes, Mega. Very good. What else you will do? Let's say now this is one of the estimates. There could be multiple estimates. How you will audit the other estimates? Let's say, for example, I am the management. I am saying there are no any other estimate in the financial statement. What you will do? You will close your audit by only auditing this estimate. Yes or no? What you will do? I am saying there is no any other estimate made in the financial statement. only this estimate is there. What you will do? How will you audit other estimates if they are? If there are none, then how will you identify that there are no estimates? Anyone? Very important point. See, that's where we need to understand how to audit them, because at times it will become very difficult to identify the completeness of the estimates. In case of litigation, we'll get the details of the cases from management and check it will have any effect on the opinion. Okay, very good. Mega. We'll get a confirmation from the management. Yes, very good. We will check the basis of valuation of other items in the financial statement. Yes, appropriately correct. Yes, very good. Now, let's understand the objectives and how we will audit this in much more detail. Okay. See, when I talk about the objective of the auditor in this particular standard, it says that the objective is to obtain sufficient and appropriate audit evidence, whether in the context of applicable financial reporting framework. So based on your applicable financial reporting framework, you need to obtain sufficient and appropriate audit evidence on the accounting estimates, fair value accounting estimates, whether recognized or disclosed are reasonable. So first you need to check whether your accounting estimates are reasonable. Second, you need to check related disclosures in the financial statements are adequate. So related disclosures relating to the accounting estimates are adequate. So reasonableness of the accounting estimates and the disclosure adequacy. These are the two things you need to do. These are the two things you need to do. And for that, first of all, see, whenever I talk about any auditing, you need to think from the planning stage. Don't go directly on the testing part. Think from the planning. So what are the points that you can think from the planning with respect to the estimate? So let's say now you have a responsibility to obtain sufficient and appropriate audit evidence. What you will do first with respect to the planning part? Only related to accounting estimate, nothing else. I'm talking about planning part. No testing, nothing as of now. Anyone? I'm talking about the planning part with respect to auditing the accounting estimates. What you will do in the planning? We cannot directly jump to the testing. There should be something we will do in the planning first, then we will jump to the testing. Anyone?
So in this, we will check like first we need to collect all the data, like how many transactions are there or in which estimations are made. So after collecting or knowing all the data, we can plan like what will the nature, time and extent of procedure to check all the data.
But what is all the data? Like if let's say for example, if you are going on the ground and I say, okay, you test estimates for me, how will you collect what is the all data? Like you have to go to the management and you need to say that, okay, give me these data. So what you will say to management?
Sir, we will collect trial balance, and in that we can see what all are the provision amount. So we will make a list of all the GL of provision amount, and then based on that we can plan our audit.
Okay. What else you will do? Okay, one is taking trial balance to verify the GLs which are there with respect to the estimates. Fine. What else you will do? Very good, Mega. Okay, I will check the previous year financial statements or areas. Perfectly fine, yes. What else?
We can ask the management also, like what all are the transactions on which estimations are made.
Very good. Yes, absolutely correct. Inquiry with the management. Yes or no? I'll do an inquiry with the management. Management, tell me What are the estimates that you have made? Because it's the responsibility of the management to make the estimates. So I'll ask management. Anyone else? What you will check or what you will do with respect to the planning? Very important thing you are missing out. Very important thing. Okay, tell me, how do you make estimate for provisions on trade receivables? How do you make provision on trade receivables? Anyone?
Sir, based on collectability, we check. Suppose we have sold a goods of 100 crore. Out of that, if 90 crore receives and remaining 10 crore is not received, so based on the past history, we make provision for 10 crore, remaining 10 crore.
Okay. Analytical procedures. I'm not talking about audit. I'm talking about making the provisions, accounting part. So one was recoverability. Very good. What else is there? How do you make provision on trade receivables? What methodology do you use? Anyone? How many of you have heard about ECL model? Expected credit loss. India's 109. It is applicable to financial instruments. I know that. Have you heard about it? Yes, no. No? Not yet? Okay. India's 109. See, okay, let's say for example, I say India's 109 is applicable, expected credit loss. You need to make estimate according to that. In that case, the previous answer, recoverability, doesn't hold good. I'm just taking an hypothetical example, okay? But the point here is that when I'm saying that recoverability concept doesn't hold good, we need to go for expected credit loss. That means the methodology to calculate the estimate goes on a total 180 degree, 360 degree turn, change. That's why it's important first to understand what is the methodology that is applicable for you. That means you need to understand the applicable financial reporting framework, whether it is the AS or the Ind AS or what is applicable to you, based on which you need to make the estimates. Otherwise, how can you determine the estimates are appropriate or not? Are you understanding the point? So you need to understand like what is the method we need to think of before making the estimates. That is the financial reporting framework. Before proceeding ahead, understand the financial reporting framework. Then take necessary other steps. Number two, you have to understand what is the requirement of disclosure under financial reporting framework. See, we are not here only to test the estimate. So one of the objective, yes, is there whether they are reasonable or not. But the another objective is disclosure also. So you need to think from the disclosure point of view also that, okay, this disclosure is something we also need to test. And this disclosure is directly related to your financial reporting framework. For example, employee benefits. There are some estimates made in that. There are some assumptions taken. So accordingly, you need to report, you need to think of the disclosures, management need to report, and you need to audit the particular estimate in this line. Yes or no? So first of all, you will understand financial reporting framework. Then you will understand, like understanding the financial reporting framework is part of the understanding the entity. Now tomorrow it's a bank. Banking Regulation Act will be applicable. RBI directions will be applicable. Financial reporting framework will change accordingly. So the first step will be understand the entity, and then the financial reporting framework will follow. Once you understand the entity, you will come to know what financial reporting framework is applicable to them. And accordingly, you will be able to understand what framework they need to follow or you need to consider for the accounting estimates. Yes or no? Great. Now, second thing is, how do you understand the entity? If I ask you what procedures do you follow or which standard do you follow to understand the entity, how will you, what will be your answer for that? How do you understand the entity? Very good, Sanjay. Absolutely correct. How do you understand the entity? Anyone else? How do you understand the entity? Very good, Mega. Yes, very good, Chitra. SA 315. We will follow SA 315 to understand the entity and its environment, including entities' internal control. And over there, we'll take an understanding of the entity's financial reporting framework. Okay, so first we will understand the entity, then its financial reporting framework, basis of accounting policies. Sometimes you have accounting policies for estimation also. So you need to understand the basis of identification of the account, like identification and assessment of the accounting estimates, accounting policies, all those things. Then you proceed ahead. Okay. Then you ask management. Management, tell me, how do you identify? First, you will ask management, how do you identify all the areas where you need to make estimate? Okay, which estimates you have made is a secondary thing. First, you tell me, how do you identify all the areas where you need to make an estimate? How do you are making sure that you have made all the estimates that are required to be made in a financial statement? Something is not left out. You need to understand that from management. Okay, you will inquire with management. Then you will management say, okay, I have a list that I follow year on year. Okay, these are the estimates that we need to follow. I'm not sure you guys have heard about FSCP, financial statement closing procedures. Okay, so there is something called FSCP, which is financial statement closing procedures, which is a list of procedures that management usually has documented that they need to perform for the closing of financial statement and for the preparation and presentation of financial statement. So at every period, let's say month end, in multinational companies, you have a month end, you have a quarter end, you have a monthly and quarterly close. So every monthly close and quarterly close, they follow FSCP, financial statement closing procedures. And based on, like, it's a kind of checklist, you can say, that where they have 1, 2, 3, 4 items where they need to follow all these steps to make sure that they are doing everything fine, like they are not missing out anything. So accordingly, they sometimes make sure that okay, they have a checklist for the or FSCP procedure for the estimates also. Accordingly, they may give you an answer. Okay, this is how we are. What you can say? We are making sure that all the estimates are complied, or all the estimates are being made. Okay, so FSCP, you can say, is one of the area. Okay, now once you identify how the management is identifying the completeness of the estimates, you will ask them, okay, management, tell me, how do you make these estimates? Completeness is done, now comes to the accuracy. Okay, tell me how you are making the estimates. What is the procedure that you are following? So what you will understand when you are understanding, let's say management tells you, okay, these are the 3 estimates that we make. What you will understand in that? What you will basically understand from management in understanding the estimate, how they are making. Anyone?
Sir, we will know basis, like on what basis management is making that provision or estimation. So basis we need to understand.
But how will you, like, what you will ask? Let's say, for example, you have to ask question from management. Management, tell me how you are making estimates. Let's say, for example, datus provision. Okay, it's based on the recoverability. Fine. Okay, management says you, okay, every year we make estimate of provision on 5%. Is this sufficient for you?
No, sir. We will ask like how this 5% you have decided. What is the reason for that 5%?
Okay, what you will further, or like, okay, that's what is the reason for 5%? Perfectly fine. What else you will ask? What else you will ask apart from 5%? Let's say management says, we, since start of the days, we have an accounting policy that we have to make 5% accounting. We have to make 5% provision on the trade receivables. Consider. Is it sufficient? Very good, Mega. 5% of which balance? What is trade receivable? What you are classifying in the trade receivable? Is it the age trade receivable? It is the not a due, which is whether it's overdue, not a due. What is the aging of that receivable on which you are considering the 5%? Are you actually going and checking what is your actual bad debt compared to the provision? Do you have any bad debt which is outstanding for more than 720 days or 3 years, basically outstanding for more than 3 years? Are you still applying 5% on them, or you are applying 100% on them? So you understand, you ask them the question on the methodology. What method you are following? Are you using any expert in this, or you are yourself making the estimate? See, trade receivables, provision, perfectly fine. Impairment of goodwill, valuation of goodwill. Is management making the estimate? Sometimes there is an estimate required for the valuation of inventory. Simple example, WIP. You cannot directly value WIP. Okay, this is WIP, this is how it should value. For example, if the company is involved into making heavy machineries, okay, at the year end, they have some machineries which are half made. How will you calculate their value? You will go and check, okay, how many screws are there, how many nut bolts are entered, so their cost plus everything. This is the value of WIP. or you will follow some other, because it involves labor also, not only material. It involves technicians' time also. How will you apportion the labor cost? I'm sure you guys have heard about marginal costing, standard costing. How will you value
Yes, sir.
your WIP in those cases? How much cost to apportion for that? A lot of valuations, a lot of estimates are required in those areas. You need to understand the model, the method which is there, whether they have used any expert, the assumptions that they are making. Number two, change in the method compared to the previous year. Since till last year they were making a provision of, let's say, 10%. Now this from this year they decided to make a provision of 5%. Very important part, the effect of the estimation uncertainty. We know it lacks precision. We know there is an uncertainty involved. How you are making sure that uncertainty is very less? It is not a random number that you are taking. It has some base behind it. How you are making sure that the uncertainty which is there, which is a lack of precision, is very less in your estimates. These are the just questions I'm telling you that you need to ask from the management. Okay, so again, like same what we have discussed, it's there in the standard. We'll go through quickly. So in understanding the estimate, first you need to understand the entity and its environment. You need to think of like what is the entity, where they work, what is the industry, everything. So as per SA 315, you need to understand the entity and environment. Based on that, you will identify the financial reporting framework which is applicable to the entity. That will tell you about how accounting estimates should be made and what is their related disclosures. Once you identify that, you need to ask management, tell me, how do you identify those transactions, events, and conditions that give rise for the need of accounting estimate? How do you make sure that all the estimates are made, all the things are complete? FSCP, remember. So management may give you an answer for this is, we follow FSCP checklist. Okay, here management might or here you may understand that okay, Ind AS is applicable. I'm just giving you answers, examples. Once you understand that, you need to ask management, have you ever thought that okay, you need to revise existing accounting estimate, or there are circumstances which may give you new accounting estimate? Means, is there any change required to this checklist? Okay, since last 10 years they are using the same checklist. Doesn't make any sense. You need to ask them, management, have you thought of circumstances that are giving rise to new estimates? Or you need to revise existing accounting estimate, new methodology, new index has come into the picture, your checklist is still following the old accounting standards. Then you need to ask management, tell me, how do you make accounting estimate? For example, method, model, simpler, like CWIP. What is the method? WIP. What is the method you use to value WIP? Relevant controls which are in place. Whether do you use an expert in making the estimate, because sometimes it's not your job. It's a very complex start. You need a specialist for that. The assumptions that you are making, how much of the cost we need to allocate. Okay, any change from prior period? We changed the provision for the bad debts or trade receivable from 10% to 5%, or warranty provision changed from the 10% to 5%. If so, then why you have changed? And the last one is the effect of the estimation uncertainty. These are the minimum questions that you need to ask and understand. This is only part of the planning. I'm not even in the testing till now. No, I'm not even have started the testing, but this is just the planning. Clear? Any doubt? So applicable financial reporting framework, your completeness of the estimates, then you have method, you need to ask about controls, you need to ask about expert, you need to ask about assumptions, you need to ask about change, you need to ask about uncertainty. These are the things you need to ask from the management. Applicable financial reporting framework, completeness, method, controls, expert, assumption, change, uncertainty. Okay. And then one more thing you need to do. If, let's say, for example, management says no provision, we need to make every year at 5%. Is there any way to validate this 5%? I'm asking you a question, that is there any way to validate this 5%? Or let's say, for example, there is this litigation that we discussed about. Okay, let's assume this litigation estimate was made in FY 23-24. Now you are standing in 25-26. Now you are standing in 25-26. So in FY 25-26, how will you validate this? How will you validate this estimate? After 2 years, I'm asking you to validate an estimate which was made 2 years before. Because it is still appearing in the balance sheet. Anyone?
Sir, in this we need to check like whether the litigation is still ongoing or it is concluded. If it is still ongoing, then we will check that whether there is any change in the provision amount or not. Those things. If it is concluded, then at what amount that was concluded, whether it was 100% or more than that or less. That all we need to see.
Absolutely correct. Very good. Yes. So we need to see the outcome. If the litigation is pending or not. If pending, at what stage? Do you have now a perfect base of the amount? Okay. Sometimes you have an interim order, penalty orders. So do you have that? Number two, if it is closed, then at what amount? And at times you can draw a reference from the other litigation. Let's say management made three estimates for the penalty in 3 litigations. Out of the 3, 2 are done. You can check, like if in those 2 cases management, let's say for example, made the 50% and they got the penalty 100%, means now you can understand that management has a tendency to make a lower estimate. So you can factor in those things. What is the outcome of the previously made estimate? Same warranty provisions, bad debt provisions. What is the outcome of actual estimate that was made previously? So now we need to think of the outcome. So I'll go back, and you need to understand that what was the estimate made and the outcome of that estimate in the subsequent accounting period. Okay, so that you can understand whether management is making the estimates which are more precise, or like their estimates are something which is full of management biasness. So based on that, based on the outcome, you can understand more about the management biasness in those estimates, or the estimation uncertainty in those estimates. Clear? But make sure one thing, that whenever you are checking the estimates which are made previously, let's say for example, management made an estimate of 5% on the provision. Simple example I'll give you. Let's say this is FY 23-24. Okay. Now there was a debtor, let's say A, trade receivable A. The provision was made of rupees 100 on his balance. FY 24-25. This 100 rupees was carried out as a provision, was carried forwarded. Balance was, let's say, rupees 150. So on 150, there was a 100 provision, because we thought 50 rupees is recoverable. So that means 50 rupees recoverable. Same here. Now in FY 25-26, there's an actual bad debt, or the party got insolvent and they are not going to pay you. Full 150. So full 150 is now not being paid. My question comes is, based on this, can I qualify, or can I say that this has to be qualified? Can I say that this has to be qualified? Can I treat this subsequent event? Yes or no? Can I go back and ask the auditor to change the previous year audit report based on that your provision is wrong? Assuming it is material. Should I say that, okay, no, your previous year opinion is now is wrong, change that? Okay, very good, Mega. Anyone?
Sir, we will check reasonableness and adequacy of the provision amount in earlier year. Means as per earlier year, as per the financial reporting framework, whether the provision amount is reasonable and adequate or not. If it is adequate and reasonable, then need not to change the earlier year amount.
Okay, very good. Anyone else? Very good. Absolutely correct. See, I can only call, or I can only question this particular part if the information was available in that year. Can only question if info was available in FY 24-25. Otherwise not. So basically, the term which is used is hindsight. Not allowed. That means you cannot take a decision, or you cannot decide based on the correct information that you have, that the decisions which are taken in the past are correct or not. See, the decisions which were taken in the past were based on that information that was available at that point in time. Now, if you re-evaluate those decisions in hindsight, based on the information now you may have available now, it is not correct. It is not appropriate to do that. So if the information was not available at that point in time, and if the information that was available based on that, if that is reasonable, fine, you should not question that. Now, what if the information was available at that point in time? Yes, that's an issue. For that, we can ask them. If there is we will see in SA 710, in SA 560, we will talk about We will talk about in SA 510 opening balances, subsequent events. We will talk about corresponding figures. If there is a misstatement in the corresponding figures, if there is a subsequent event, if there is a issue in the opening balance, we can ask for a modification. But provided that information was available at that point in time, otherwise you cannot. So if the information is not available and the decisions that were taken at that point in time were based on that information, fine, don't question it. So simple. You cannot, it's not intended to call questions the judgment made in the prior period that were based on the information available at that point in time. Doesn't make, it's not reasonable to do that. Okay, so hindsight is not allowed. I can raise a question when the information was available in that year itself, otherwise I cannot. Clear with this? Okay, now based on all this information, what I will do, I asked so many questions from management. Now what to do? Now, based on all this information, what should I do?
Sir, after the planning stage, we need to decide nature, timing, and extent of the procedure, how much we need to audit, and audit program also we need to draft, assigning the team on what all the things need to check by the team, those things.
Yes, very good. Yes, audit timing and extent, perfectly fine. But how will you decide how much audit is required? Let's say management gave you all these answers. Will you be able to directly decide, okay, now this much is the audit we need to do? Okay, you might be aware about what is the nature, timing, and extent you need to put into. How your team members will come to know how much testing they need to do.
Sir, we need to communicate with team member as well, no? In the planning stage also. We need to guide them like how much they have to audit the transactions and all.
Absolutely, yes, very good. Communicate with them how much they need to audit. So you will decide nature, timing, and extent. But to decide the nature, timing, and extent, you need to do something. You need to decide first the risk of material misstatement involved in this. Let's say after understanding everything, I understood it is not material enough. The estimate is not material for my financial statement. Will I invest that much time? No, it is not material. So, to decide whether I need to test or not, I need to first decide the risk of material misstatement by understanding the materiality, degree of uncertainty, and significant risk involved. So, risk assessment is something that I will do. Once I say that, okay, this is a significant risk area, it's a material area, there's a risk of material misstatement, I will go and audit. It's not necessary. Let's say, for example, this one, 150, 100, everything. Okay. The same example, I'm keeping it. Now, total AR balance, if I'm seeing in FY 25-26, total AR balance, ₹150 crores. Out of that, there is 100 pure, only 100 rupees, only 150 rupees, not crores. I'm not adding any crores in behind of that. Absolute number 100. Will you go and test? I'm talking about there is a data of 150 rupees in front of 150 crore of total AR. Will you go and test?
Only 100 is not a material amount, sir.
Yes. So my nature, timing, and extent will be based on the materiality. based on the risk that I identify in this particular process. Let's say after understanding everything, completeness, method, control, expert, I am fine. Like management is making reasonable estimate. Or for example, let's say valuation estimate. So they are hiring an independent third party to make estimates. They are issuing their report on the basis of that management is making the estimate. Accordingly, I need to assume like, okay, what is the risk involved? How much testing I need to do? It shouldn't be, see, each and every estimate will have a different kind of risk. And each and every risk requires a different kind of testing and different level of testing. So the level of testing will be based on the level of risk. I cannot directly jump and say, okay, I will test 10 transactions, 20 transactions, 50 transactions. I will involve 1 week, 2 weeks. No one fit approach can be, adopted in this particular scenario. As a result, what I need to do is I need to first understand the risk that is assigned or that is there for this particular estimate or for all the estimates, their respective risk assessment, risk of material misstatement, and then on the basis of that, I will decide the approach of the testing. Okay. So first I will understand risk of material misstatement based on the estimation, degree of estimation, uncertainty. And then I will go ahead, okay, now it's time to determine whether there is a significant risk or not. Based on that, I will decide what testing is required to be done. Okay. Now, in case of testing, it is pretty straightforward and simple. If I tell you, testing it's simple. Number one, our question, applicable financial reporting framework, we'll ask them what applicable financial reporting framework it is. Management said in theirs. I will go and check whether they have applied the applicable financial reporting framework appropriately or not, whether they have applied the Ind AS appropriately or not. Second, I ask them that, okay, are you, identifying all the estimates completely? Like how do I identify financial statement checklist procedures? Okay. And are you identifying any change or anything? So management says, yes, every year we revise the checklist. I just ensure it. Management is identifying all the relevant accounting estimates. And if they are, following the checklist, they are following it consistently. If there is any change, then the change are recorded appropriately. Okay. So that is something we'll ask from them. Whether any change, then if yes, then what are the changes with respect to the prior periods, whether they are appropriate in the circumstances or not. Then we ask management, tell me about your method. Management told me about the method. I will validate that method, whether the method for making accounting estimates are appropriate. And then we ask management, what controls you have, relevant controls. Management will tell you, okay, these are the controls that we have. I will go and test the controls. If I talk about like how the management is in, I will test the operating effectiveness of the controls on how management is making the accounting estimates. Okay, what was our question then? Assumptions, change from the prior period and effect of estimation uncertainty. Now, when I talk about assumptions, what assumptions management is taking? See, with respect to the assumptions, we need to also understand what is the, whether the assumptions are appropriate or not. Okay, like whatever assumptions management will make, we have to validate those assumptions. So we'll go and validate the assumptions used by management, whether they are reasonable or not. You cannot say whether they are correct or not because they are assumptions. You cannot comment on the correctness of the assumptions, but you can comment on the reasonableness of the assumptions. Correctness of the assumptions might not be possible, but you can say reasonableness of the assumptions with respect to the applicable financial reporting framework. Then estimation uncertainty. Okay. How management is taking care of estimation uncertainty. So you need to understand from management, tell me one thing, how you are making sure that there is no estimation uncertainty, higher estimation uncertainty involved in this, or how you are, making sure that your estimates that you are making are not that much, away from the actual outcome. Okay. So for that, there are things that we need to ask from the management with respect to estimation uncertainty. Okay. A separate detailed testing is required to be done for that. We'll come on that particular part. But apart from that, if you see whatever questions we have asked from management, testing will be done on that area only. Okay. Plus, as I told you in this example, that hindsight not allowed. Only if the information was available in that particular financial year, then only we can go and talk about that. Plus, we can also check about this one, outcome of the accounting estimate. So tell me one thing, can I know the outcome of the accounting estimate for a particular year before I issue the audit report? Let's say, for example, at the year end, management made an estimate. Can I know that outcome of the estimate before I issue a audit report of that particular year? Yes, no. Okay, no. It's probable. Okay. I'm giving an example. This provision, okay. Provision made on 31st March. Provision on 31st March. Rupees 100. Audit report issued 20th September. Insolvency. When he filed for the insolvency, 30th June. Now tell me, do I have the information available before I issue my audit report about the provision?
Yes, sir. In this case, we are having information about insolvency.
Can I say this is the event up to the date of audit report? Events
Yes, sir.
occurring up to the date of audit report is relevant over here. As a result, all the events up to the date of audit report, we will determine those events and we will consider that can provide you audit evidence regarding accounting estimates. Okay, so this is something we will evaluate, events occurring up to the date of audit report. And then we will test how management made the accounting estimate, like the data, whether they are taking all the account receivables, whether they are taking some account receivables, what data they are using to make the accounting. So these are few things that we will do when we are testing accounting estimates. There are further things to discuss, but any doubt till now?
Sir, in the same example, if the outcome of that provision we come to know on the, like, suppose 24th, sir, 20th September is the audit report date, but we come to know about that insolvency on 21st September. Then what will be the cases? Like, what can we do?
We will discuss this particular, example again back in subsequent events. See, there are events which may occur before the issuance of audit report. There are events which may occur after the issuance of audit report. Now we need to understand whether the events and conditions for that particular event were available before the issuance of audit report or not, whether it could be an adjusting event, non-adjusting event. We need to understand from that point of view. So this everything, if I talk about, will be discussed in SA 560. I hope I'm clear.
Yes, sir. Clear.
Okay. Any doubt till now? Any doubt? Okay. If no doubts, what I propose is let's take a quick 10-minute break. After the break, we'll gather back and continue the discussion on 540. Okay. Let's take a quick 10-minute break. Ashok ji. Yes. Thank you. let's continue. Now we will discuss about one important aspect that we haven't touched till now. This part, estimation uncertainty. Okay. Now, why we discussed about this particular part in the start, why we discussed about the management biasness and how to basically tackle it. See, we know about the method, we know about the assumptions and everything now. But at times, trust me, it becomes very difficult when you have to calculate the estimate. It's not that simple. Even after assumptions, how can you say to management that management, these assumptions are wrong? Because these are assumptions. You can only comment upon the reasonableness of the assumptions. We just now saw that we cannot comment about the correctness of the assumptions. We can only talk about the reasonableness of the assumptions. Yes or no? We only can talk about reasonableness of the assumptions. Now, in that case, it becomes very difficult for us to comment on the whether the assumptions are reasonable or not. See, one thing is, I'll give you an example. Some like where the management, let's say over here, management made in provision of 100. As per my assumptions, it was 120. Let's say in this particular year only, 24-25. Okay. When management made in provision of 100 as a reasonable assumption, I said no, 120 should be the reasonable assumptions. When I talk about reasonable, two assumptions can be reasonable. I'm not talking about correctness. I'm talking about reasonableness. Okay. My assumption can also be reasonable based on my estimates, my methodologies. Management assumptions can also be reasonable. Now, in the scenario when both the assumptions can be reasonable, what you will do? Will you qualify your audit report for that? Will you call that as a misstatement?
No, sir.
Then how will you deal in that particular scenario where you are also right or reasonable rather, and management is also reasonable? How will you do that?
We will check like whatever the information was available at the time of making of the provision. Based on all those information, provision has been made or not. If it is not met, then it is not adequate, or I can say like it is not reasonable.
Yes, absolutely correct. See, when you are making your assumptions or when you are correct considering your own assumptions and when you compare your output with management's output, you have to factor in for the difference. If the management's assumption is also reasonable, my assumption is also reasonable. As per the management, the outcome is 100. As per my assumption, the outcome is 120. Then I need to factor in the difference. I need to say that okay, this difference of 20 between my and management's assumption is not a misstatement. It's the difference based on the assumptions, and I should be fine with that. But for that, I need to understand the assumption made by the management. It should be reasonable. That's why at the first stage I said it should be reasonable. If the management assumptions are reasonable, you are taking different assumptions, those are also reasonable, then factor in the difference. Factor in the difference means consider that, okay, you should be considered of that difference, that fine, there could be difference because we are taking different kind of assumptions. Now, sometimes management might have multiple outcomes. Okay, I'm not sure if you guys are aware about the probability system of making estimate, where like what happens in the probability based estimations. Okay, what happens is I'll explain you with an example. Okay, let's say management decided there is a account receivable balance of a particular company or trade receivable or party, whatever you want to call it. Let's say Mr. X. The balance is rupees 1000. Now management has a probability of bad debt. As per the management assumptions, there are scenario, the probability is in range. That means there are 50% chances also, there are 70% chances also, there are 100% chances also. Now, we cannot estimate the probability because we don't know what is going to happen. Estimation uncertainty. I'm talking about estimation uncertainty. Okay, we don't know. That's why management came up with a different probabilities. Okay, so let's say 100, let's say 1000, sorry, 1000. The probability of bad debt is 50, 70, and 100 in these scenarios. So what management thought is, okay, instead of taking a particular estimate, let's do a range estimate. That means my bad debt can range from rupees 500 to rupees 1000. This is a range for my bad debt. It can be, because sometimes you don't have the exact outcome because of the uncertainty involved. That's why you have a range. Now, because of that range, what will happen is management might take up, let's say, if in this case, management has an option of 500 to 1000, anything in between. Let's say management came with an outcome of, I will make an 750. Based on the range, I'm going average in the range, it's 750. Okay, average of the range. There is no any other methodology available, assume for time being, based on the information. Now, in order to validate this, there are two methods to do that. Number one, auditor has to also develop a range. So auditor will prepare his own range based on the probabilities, and this is the assumption. Now, these are the assumptions. This has to be reasonable. So based on these reasonable assumptions, auditor will develop its own range. And based on that, auditor might come up with a different answer, or a range which is, something similar to the management's range. So at that point in time, when the range is being used by management, we as an auditor we have to develop our own range also. Now, when you have a one definite answer of the outcome, it is called as a point estimate. Okay, exact management point estimate, like the fixed amount, 100. When you have a range, 500 to 1000, that is a range estimate. Now, if you are evaluating the point estimate, understand the assumptions. And if you are taking different assumptions, if your assumptions and method differ from management, consider the differences. Okay, you need to evaluate any significant differences from the management points estimate by considering the relevant variables. That factor in the relevant variables, and then you think of that. But if it is the what you can say range, if you are using a range 50 to 1000, then narrow the range based on the audit evidence available, and then compare the outcome. For example, you have a limited information with you, so you cannot have a fixed amount. So you are also developing a range, and you then need to narrow out the range based on the information available, and then you need to check it is appropriate or not. Okay. And if you think you need a specialized skill, you may go for auditor's expert. Now, another question that you need to ask management is how management is considering alternatives. For example, in this range, there was option of 150 also, there was option of 1000 also. Why 750? Why average? Why not maximum? Why not minimum? So your question should be, why average? Here, When you have multiple outcomes, you may ask question, why average? Why not maximum? Or minimum? This is the uncertainty. So we need to ask management for the uncertainty to understand what? This is a decision making, management decision, yes or no? This average is management decision. Now this decision is giving rise to what? This management decision is giving rise to one more issue.
Management biasness.
Absolutely correct. Management biasness. There is a management bias involved in this because it could be. I'm not sure. This is the risk I'm talking about. Why average? This average decision can involve management bias. And to understand that, we need to ask management, why this? So have you considered the alternative? Have you considered 500? Have you considered 1000? If you have rejected them, why you rejected them? Why you went with average? What is the reason of having average? Okay. So you need to ask management when there is an option available, have you considered alternatives? How management has considered alternatives? And if it has rejected them, okay, how you are saying that whatever option you have taken, okay, are addressing the uncertainty? Like if you had taken 750, how can you say that the outcome will be near to 750, not away from 750? Then you need to check whether management assumptions are reasonable or not. Like whatever outcome it give you for the answer for the question of why, need to like you need to check whether they are relevant, reasonable. And again, reasonableness from the point of view of your applicable financial reporting framework, whether it is allowed under the applicable financial reporting framework. If you think management has not given you appropriate answers, okay, then you need to evaluate by your own audit procedures. See, it may happen that management said you, like for this why, management has not provided you any answer. If it is not providing any answer, in that you need to develop on your own estimates, and then you need to test the management estimate with your own estimates, comparison, or kind of a recalculation. Okay, if you don't have an adequate answer of estimation uncertainty, then develop a range with evaluate the reasonableness of the accounting estimate. You develop your own. Clear? Once you do that, you need to understand whether the management decisions to recognize or measurement basis are appropriate or not based on the financial reporting framework. If you think they are not based on the available evidence, that means they are misstated. And misstated financial reporting, misstated accounting estimates. It's a misstatement. If you think they are not reasonable, then there is a misstatement. And accordingly, you need to think from that point of view. And everywhere, you need to think of the biasness wherever the management decisions are involved. Okay, biasness will come. So, auditors shall review the judgments and decisions made by the management in making the accounting estimate to identify whether there are possible indications of management biasness. Because the more the biasness, the less the reasonableness. Remember that. The more the biasness, it will be, the less will be reasonableness. Okay, there is a direct relation between them. More biasness is equal to the less reasonableness. So we need to identify how much biasness is there, judgments in the assumptions. If more biasness, no, it's not reasonable. It cannot be reasonable because it is based on the biasness, not the reasonableness. Clear? Any doubt with respect to any of the point that we have discussed?
Sir, in the same example, I have a query. Like suppose auditor has also calculated the outcome, means the why question that we asked to the management, and management was not able to answer. In that case, auditor also calculated, and suppose auditor calculated the amount of 900 of provision amount. Then in that case, whether management need to revise their provision amount or what, means because it is just provision only, no, not actual anything has happened yet.
Provision do have impact on the financials. It's not like that provisions they don't have. Provisions can deviate or can impact. See, for example, if I take a provision which is more favorable, more optimistic, my financials will look good, and it may have an impact on the decision making of the user or reader. Okay. Now, let's say, for example, 750 to 900. Okay, this is the example. But what if my profit is only 100 rupees? In that particular case, 900 or 700 difference is a very big difference when it comes to the profit. It can make the financials from profit making to loss making. So in those scenarios, it becomes very imperative to understand whether the difference between 750 and 900 is because of the different reasonable assumptions, or it is something that management's assumptions are not reasonable, auditors' assumptions are reasonable, and that is a misstatement. So if I talk about management assumptions, okay, and auditors' assumptions. In first of the scenario, if I say management assumption reasonable, let me bring this. Auditor assumption reasonable. In that case, you can say difference in estimate is not misstatement, provided the difference should be reasonable. Okay, then I'm talking about reasonable difference. What is a reasonable difference? I'll give you an example. Let's say, for example, over here, management was 100. Your outcome came rupees 110. Now, 10 is not material enough. In that case, if 10 is not, I will say rupees 10 not material, it is reasonable. That is a reasonable difference. Now, for example, another example, let's say second, management assumptions not reasonable, and your are reasonable, obviously. Like we are auditors, we have to be reasonable. Reasonable. Okay. In that case, difference. So here the difference will be unreasonable difference. Unreasonable difference is misstatement. Clear? I'll give you an example. Management said rupees 100. My assumption is 150. Rupees 50 is material. When I talk about material over here, materiality not in terms of the financial statement, materiality in terms of that particular line item, okay, or the total provision or something like that. Do not consider overall materiality over here. Okay, it's not overall materiality. It could be the scenario that it might be material from the line item perspective, from the provisions perspective, but not material as per the overall materiality. Could be the scenario. Third, very important part. Again, management estimates reasonable. Mine is also reasonable as an auditor. But the difference is unreasonable. unreasonable difference. Now, this is a very big issue. Let's say, for example, management said rupees 100, that is reasonable. I said rupees 150, that is also reasonable. Why? Because of higher estimate uncertainty. So here, this is because of higher estimation uncertainty. This could happen. And in that scenario, what is the responsibility of auditor? The responsibility of auditor is to develop range of estimate, then narrow it down, and then compare. If still it is unreasonable, you can call it a misstatement. If it is after narrowing it down, when you are comparing, there should be two scenarios. One, difference is there, difference is high, difference is low. So obviously, low difference, fine, ignore. High difference could be a misstatement. Why I'm saying could be a misstatement? Because the estimate, the assumptions which are taken by management are reasonable. Due to high estimation uncertainty, I am having a high difference. This high difference is because of this one, high estimation uncertainty. Now, in this particular scenario, there could be, I need to have other methods involved to validate the difference or the estimate. For example, subsequent outcome. For example, hiring an auditor's expert, or something more, like for example, if I have similar estimates being made last year, I will check their outcome in the current year. So I will use other methodologies and audit procedures to validate that. That's why I said could be a misstatement, but requires further audit procedure. Clear? So these are the three scenarios where issue can be there, or how you need to deal the estimates, basically the summary. Any doubt?
No, sir. This is really very helpful. Thank you.
That was SA 540 that we discussed. We'll quickly go through the study material and we will see what is, how it is related and how it is very important. Okay. It will help you in reading the study material also. So, scope of this essay, we have talked about, like it is auditor's responsibility regarding accounting estimates, related disclosures. That is the scope of 540. Okay. Now, nature of accounting estimate, we understood. Estimation uncertainty is involved very much, and degree of estimation uncertainty can be related to risk of material misstatement. The higher uncertainty, the higher misstatement can be there, chances of misstatement. Okay. In that case, we need to understand why the uncertainty is there. So you need to understand the degree of estimation uncertainty based on the nature of accounting estimate, generally accepted methods, assumptions, okay, which are being made in that. Then management bias that we discussed about. What is management bias? How it can impact? Okay. Measurement objectively of the accounting estimate. You have to measure the accounting estimate appropriately so that you can, understand how they are made. These are the objectives that we discussed, like it should be reasonable and adequate. Then some definitions that we have already discussed: accounting estimate, management bias, auditor's point estimate and range estimation uncertainty, management's point estimate, exact amount, outcome of an estimate. Then you need to do risk assessment, like applicable financial reporting framework, how management identify those transactions, okay, checklist sort of thing. obtaining an understanding of how management identifies the need for accounting estimate. Then method, controls, expert, assumptions, changes from the prior period, estimation uncertainty, how management is making the estimates that we discussed, estimation uncertainty, how it is impacting that. Okay. Then what do you need to do with respect to the testing part? When you are testing, first of all, you need to perform the risk of material. You need to understand the risk of material misstatement. Then only you can go for testing. Okay. So once you decide the risk of material misstatement, then you will, based on that, you will decide how much time is required and what testing to be done. For example, you need to understand that, okay, how the estimates are made, whether the methods are appropriate and consistently applied, changes are appropriate or not. Okay, what accounting applicable financial reporting framework has been applied. Then determine the events occurring to the auditor's date, subsequent events, test check of the data. Sorry, test check of the data. Then test the methods, whether they are reasonable or not, assumptions, whether they are reasonable or not. Okay. In that case, then you need to talk about more on the data, like how the data is being used, which data is used, whether full trade receivables, half trade receivables, the source of the data. If it is the external data, then reliability of the external data, effectiveness of the controls which are there. Okay. You may need to recalculate the accounting estimate, and we'll see how to recalculate. So you then need to see whether the recalculation with which is there is appropriate or not. So disclosure related accounting estimates are there, presentation disclosure part, and that's the SA 540 which is given in your study material. The similar, the what we discussed. Clear? Any doubt? This is the quality control part with respect to the basically accounting estimates. With respect to, you need to follow the quality control. See, quality control, as I discussed in the first chapter, in this, when we were discussing the first chapter, I discussed that it will be applicable at each and every phase. It's not like that we are discussing now and it will not be applicable. It will be applicable at each and every phase. So that's the quality control. Any further doubts with respect to SA 540? Okay. If no further doubts, then I need to discuss one more very important standard. Okay, very simple, very straightforward, nothing difficult in this, I would say, but very important standard. A lot of times we talk about misstatement and evaluation of the misstatement. We will talk about, okay, we will talk about misstatement. We need to evaluate whether the misstatement is material or not. So when we will talk about misstatement, we will talk about materiality of the misstatement, whether misstatement is material or not. But how to identify whether a misstatement is material or not? You will say based on materiality. Perfectly fine. Is it the only materiality that we need to consider when it comes to the evaluating the misstatement? Answer is no. There are other factors that we need to understand when we are evaluating the misstatement identified during the audit. Okay. So for that, we have a SA 450, which talks about evaluation of the misstatement identified during the audit. Now here, the important thing that we need to understand is evaluation and misstatement. Okay, my first question to all of you, what is a misstatement? We'll go to the evaluation later on. What is a misstatement? Can anyone explain me the term misstatement? Anyone? What is misstatement? No? Okay. So let's say difference in amount, classification, presentation, disclosure made in FX, then actually required. Absolutely correct. So misstatement is not only related to amounts. Most of us, we talk about difference in amount, then what is required. But misstatement is beyond amounts. It's not only amount. So when I talk about misstatement, it is, yes, difference in amounts, it's there, but also classification and disclosure. What is classification? What if I show 100 rupees sales as a 100 rupees purchase? What if I show 100 rupees of travel expense as an 100 rupees of your professional fees? There is no difference in the amount, but it's the issue of classification. What if I capitalize 100 rupees of professional fees into the fixed assets as an intangible in development? That's the disclosure part. You cannot capitalize unless you are going to get the benefits beyond one of the accounting period. So amount, classification, disclosure, even for, let's say, for example, there is a disclosure required by a particular standard. Let's say related party related deferred tax. Now there is a specific disclosure required for the deferred tax. Management has not made any such disclosure. Issue. That's a misstatement, missing disclosure. Okay. So when I talk about difference in amount, classification, and disclosure, then what it should be, then compared to then what it should be, it is a misstatement. Pretty simple. Okay. Now second question comes is that when I talk about misstatement, is this include corrected misstatements or it is only uncorrected misstatements? Misstatements which are corrected. Are
In
you
audit
required?
report, misstatement will only consider about uncorrected only. Corrected will be okay.
Okay. Now tell me, do you think the corrected misstatements have any impact on the opinion? Corrected misstatements having impact on the opinion?
Yes, sir, it will have no. Suppose some of misstatement was due to that financial statement could have been unmodified, but managers had now corrected that misstatement. Now auditor is okay with that, so then it will issue qualified means correct report, clear report.
Clear opinion. Okay, fine. Let's say, for example, there was a missing provision, bad debt provision. We identified, management corrected it, provided, we are issuing unmodified opinion. Do you think it will have any other effect? Management corrected it. Apart from that, okay, management corrected it. Now I'm providing the unmodified opinion. Do you think it will have any other impact? Anyone?
Sir, it will have impact on income statement, like profit will get reduced due to that provision amount.
But will it have any impact on audit? Will it have any other impact on audit? Financial statement, fine. Provision was not provided. Now they provided profit change. Perfectly fine. Do you think the corrected misstatement will have any other impact on audit? No. Okay. Anyone else with a different answer? Okay, I'll tell you one example. Then you tell me. Let's say I'm talking about date wise. Date, okay, event, what happened, and then now let's say it's 19th September. Audit team identified incorrect classification of sales. 19th September, management corrected classification, resulting in decrease of profit by 10% of total profit. So whatever earlier total profit was, it decreased by 10%. Let's say earlier it was 100, now it became 90. So 10% is the of total profit is the amount which is corrected. I'm talking about 20th September due date for signing audit report. Will you sign the audit report? Will you sign the audit report? Assuming every other part of the audit is done. So the testing and everything was already complete before 19th. There is no testing remaining. At 20th, will you sign now audit report? Very good, Megha. Very good. Okay, Chitra. Good. Okay, good, Hetal. Will you sign the audit report? Very important question. Trust me. No? Okay. So I got an answer from Megha, Chitra, and Hetal. Good. If I'll give you an answer. If I was on your place, I will not sign. That's where the term evaluation comes into the picture. I'll tell you why. This is a misstatement. This is a corrected misstatement. Correction does not mean evaluation. Correction means they rectified it. But this corrected misstatement, when I will evaluate, it will give me chances of having similar other misstatement. Chances of having similar other misstatement. This will result in change of risk of material misstatement that was decided at the planning. Now my risk of material misstatement will change because there was an incorrect classification. I need to go back and check, was my audit procedure sufficient enough? Why this was? Are there any other similar cases? Do I have sufficient and appropriate audit evidence to say that there are no other misstatement? That is the evaluation that you need to do. Evaluation is not the correction. Most of us say that, most of us believe evaluation is equal to suggesting corrections. But that is totally incorrect. When I talk about evaluation, evaluation not only on opinion, evaluation on your audit plan, evaluation and the impact of that particular misstatement, whether corrected or not, on your audit program. You need to evaluate the impact of the misstatement on your audit program. You need to evaluate whether you have the sufficient and appropriate audit evidence or not. And then you need to decide, should I go or not for the signing. So when I talk about evaluation, it is evaluation does not mean correction. Evaluation means evaluation of the audit program based on the identified misstatement. Evaluation of the sufficient and appropriate audit evidence that you already have, whether you have that sufficient or not. So if I go and talk about the objective of this particular standard, it says that you need to evaluate the effect of identified misstatement on audit. When I talk about here, the term specifically mentions identified, not only uncorrected. Identified will include corrected plus uncorrected. Both. And when I talk about audit, the term audit is not the opinion only. Okay. Most of us think it is only opinion, but it is opinion plus your audit planning, execution, and reporting. Why I am writing separately reporting? Reporting, do you think reporting and opinion is same? Question. That is opinion and reporting are same terms. Do you think opinion and reporting are same terms?
No, sir, it is different.
Absolutely correct. Very good. Yes. Yes, Megha. Opinion is part of reporting. Reporting, it does not mean opinion. So they are not same terms. Because reporting includes reporting to those charged with governance, reporting includes to management, reporting may include to relevant regulatory authority. Opinion is a part of a reporting. So when I talk about audit planning, execution, and reporting, it is more than opinion. Effect of identified misstatement on the audit. You need to now broaden the horizon. What is the impact of identified misstatement on my reporting to those charged with governance or audit committee? So for example, on 19th, you already gave a presentation to audit committee. Now you need to think again. Do I need to revise that presentation? Am I required to report back to the audit committee about this misstatement? So is there any reporting responsibility of the misstatement to audit committee or those charged with governance? Is there any reporting requirement of misstatement to those charged with governance? Yes, no. Come on, it's pretty easy here. We have discussed already. I'm pretty much sure we have discussed. Very good, Sanjay. But there is one more thing that to your answer. We have discussed this part. Is there any reporting requirement of misstatement to audit committee or those charged with governance? Is auditor required to report misstatement to those charged with governance? No? Okay, I'm giving you three options. Yes, no, can't say. At least provide the options. Based on the options, give an answer.
Yes. Yeah.
Okay. Anyone else with any other option? Very good, Sanjay. Okay. Very good, Chitta. Okay. I'll tell you the answer and the reason. Yes, auditor is required to report the misstatement to the those charged with governance because we have SA 260 in place. Remember when we discussed about communication with those charged with governance, over there, if there is a material misstatement, we will inform them. Anything which is changing the form and content of the audit report, we will inform them. We will discuss with them. SA 260, yes or no? So, when you identify a misstatement on 19, which is corrected by management, you still hold a responsibility to report to those charged with governance because it is corrected by management. I'm not sure whether those charged with governance are aware or not. Even though if management reported, it does not reduce your responsibility to report. Remember in SA 260, when we were discussing whether reporting by management reduce the responsibility of the auditor, we discussed that no, it does not. In that case, you have to report. I'll go back to the SA 260. So we discussed this particular part that that communication by management with those charged with governance of the matters that auditor is required to communicate does not relieve auditor of their responsibility to communicate them. And one of such responsibility to communicate is circumstances that affect the form and content of audit report, which includes a lot of things in this, which includes the misstatement also. So if there is a misstatement, that definitely will affect the form and content of the audit report. You need to report to them that, okay, these are the misstatements that is impacting the opinion. Now, earlier it was modified, unmodified opinion. Now it will be modified opinion. Or maybe now you may classify that as a key audit matter because significant difficulties involved. We encounter significant difficulties. That is last moment identification. Significant matters arise during the audit. A lot of things were there that we discussed at that point in time. So we will discuss all these things with management or with those charged with governance. That is part of our responsibility. And if management is discussing or not, will not reduce our responsibility. So when you identify a misstatement, you need to evaluate what impact it will have on your audit plan, audit, your execution, and reporting. Now, one of our objective was to evaluate the effect of identified misstatement, and second objective is to evaluate the effect of uncorrected misstatement. Now, once you identify the impact of the misstatement, if you evaluate the impact of identified misstatement, then you go and say, okay, out of these, this is corrected, not corrected. Corrected will have this impact on the planning, execution, and reporting. Uncorrected will have this impact on the planning, execution, and reporting. Plus, uncorrected will have this impact on the financial statement. On the financial statement, that means when you are reporting a misstatement or a qualified opinion, you need to think whether financial statement are materially misstated. So because of this uncorrected misstatement, your question should be, is financial statement are materially misstated? Over and above your planning, execution, and reporting, uncorrected misstatement could misstate the financial statements. That is will now depend upon the materiality of those misstatements. So for that, what you need to do is you need to accumulate all the misstatement. Once you accumulate all the misstatements, then you can say that, okay, at the end, whether your accumulated uncorrected misstatement are causing your financial statements to be materially misstated, and then you will issue an opinion accordingly. Okay, so once you identify a misstatement, first of all, what you do is accumulate them. Okay, other than the trivial in nature, other than those trivial in nature means very small, minuscule, 2 rupee difference. In the balance sheet, which are rounded to crores, you have a 2 rupee difference. Ignore that. Okay. Then you need to understand the nature of identified misstatement and whether their occurrence indicate other misstatement that may exist. Similar misstatements, although corrected, but do they, points toward other similar misstatements? Okay, and the aggregate of the misstatement accumulated, what is their materiality? What is the impact of them on the audit? Okay, for example, sales. There were, let's say, I'll give you an example. Sales, total sales I'm talking about is 100 crores. During audit, you identified misstatement. Okay, which is equivalent to rupees 50 crores. Now these are corrected. Don't you think this 50 crore will now change risk of material misstatement to very high? So it's not that I need to check one particular misstatement and evaluate that. I need to accumulate all the misstatements. Let's say this 50 is divided into 4 different misstatements. So let's say 10 CR, 5 CR, again, let's say 35 CR. Okay. Or let's say 30. I'll make it to 30 here. 30 CR, 5 CR. Let's say if I'm going to 5 CR, it could be small. But in accumulation, it is 50 CR. So I need to accumulate them and then need to evaluate the impact of that. Once I accumulate, I need to evaluate the impact. Then I need to, ask management, please rectify this. It is not appropriate if you don't rectify. So you need to ask management to rectify it and then request management provide me the class transaction account balance and the corrected misstatement. Means after correction, provide me the details back, like you have corrected. Show me the evidence. Okay. And then you need to do again audit procedures. Like for example, this reclassification 50 crores. I tested this balance before. This is tested. Now this wrong classification, this particular 50 crore balance, after correction, don't you think I'm required to test this balance also for the sales? Yes or no? Earlier, I tested 100 crores from the point of view of sales. Now 50 crores identified, which was sitting somewhere else. Let's say, for example, management forgot to book sales in front of advance received. So something was, lying in the advance received. Management forgot to book sales. Now I identify 50 crores where management forgot to book sales. Don't you think I need to audit this 50 CR also? The way I audited 100? Yes. So I need to perform additional procedures to determine whether misstatement remains or not, whether it has been rectified, the new balance is appropriate or not, the new transactions are appropriate or not. Then communicate on a timely basis all misstatements unless prohibited by law. Okay, if the misstatement is resulting the fraud, management is involved in the fraud, those charged with governance are involved in the fraud, you might not report that misstatement. If management refuse to correct, simple, then understand whether your financial statements are free from material misstatement or not, whether your financial statements are materially misstated, and accordingly you need to issue the opinion. Okay, so evaluate the impact of uncorrected misstatement on financial statements. Okay. Then you need to see the size and nature of the misstatements, which are there, uncorrected misstatements, size and nature of that. Effect of uncorrected misstatement related to prior periods. If it is related to the previous year, which is coming now, on the basis of that, then once you evaluate this particular part, then you go to SA 705. After evaluation, you go to SA 705 in order to issue the opinion. Okay, and then communication with those charged with governance and written representation. So that is the evaluation. Again, documentation and everything will come into the place. So it is there always. That is the evaluation of misstatement, SA 450. Evaluation does not mean suggesting corrections. Evaluation is beyond your correction. Clear? Any doubt? Any doubt? So in your study material, you have 4.5.7 as a SF 540, chapter number 3, where, like, again, we discussed about effect of identified misstatement, effect of uncorrected misstatement that you need to understand, you need to evaluate, definition of a misstatement. Okay, and uncorrected means which is not yet corrected. So if it is a trivial in nature, not material, okay. If it is trivial in nature, very, very small, very, very small, not material, could be bigger, but I'm saying very small, 1 rupee, 2 rupee in front of crores. Okay. In that case, ignore. But if it is not material, see, trivial is not equivalent to not material. For example, materiality is, let's say, 100 rupees. Materiality level is 100 rupees. When I say trivial, it could be rupee 1. But when I say not a material, it is anything between 1 to 100. Anything between 1 to 100 is a not material. So clearly, trivial and not material are not equal. So you need to understand whether it's a trivial or not material. And accordingly, you need to accumulate the misstatement. So accumulation will happen whether material or not, except for trivial. Okay. So except for trivial, you will do the accumulation. And once it is like, trivial, then you need to ignore, otherwise you not. Then comes the type of misstatement. One is an factual misstatement, actual difference, classification related. One is a judgmental misstatement with respect to estimates. Just now we saw. One is a projected misstatement. Judgmental misstatement is kind of where I say the management is unreasonable. If I go back to my, there was total balance is rupees, let's say 1,000, out of which tested trade receivables is rupees 100. Tested. And in this tested, I identified misstatement of rupees 10. Now I can say that in front of 100, if I have a misstatement of 10, then in front of total balance, I could have a misstatement of rupees 100. Now this, how I derive the 100 is something is this, like 1,000 into 10 by 100. This is known as a projection. That I'm projecting the misstatement of the testing amount over the population. This is the population. This is the testing total. This is the misstatement in the sample tested. So what I'm doing is I'm projecting the misstatement in the sample tested based on the testing total on total population. So I am extrapolating this 10 for 1000 based on this 100. That's known as a projected misstatement, which might be there. I don't know as of now. I'm not sure, but it could be there. Based on my testing, there could be a misstatement which is being projected to 100 based on my testing over the 100 rupees where I got a 10 rupee misstatement. I'm projecting something. Okay, so that's a projected misstatement. So misstatement can be projected, judgmental, and factual. You need to understand which kind of misstatement it is. And accordingly, you need to do the accumulation. Okay. You need to understand the nature and the identified misstatement. What is the nature of identified misstatement? It could may result that there could be similar other misstatements. Occurrence of other misstatement of similar nature or related nature. And you need to understand the impact of the aggregated misstatement on the audit approach based on materiality. Like, do you need to change your audit approach, execution, planning, and reporting? You need to communication of the corrected misstatements. Okay. You need to evaluate the effect of uncorrected misstatement based on materiality. Now, it could be like, you need to understand the size and nature of the misstatement. You need to check the effect of uncorrected misstatement, whether it is related to prior periods. Okay. And then you need to discuss and issue the opinion as per SA 705. And the last one is communication with those charged with governance. You need to communicate. We have already discussed SA 620. You need to communicate with them. Written representation, documentation, and that's it. Your SA 450. Any doubts with respect to the study material part also? Okay. If no doubts, what I propose here is this is your chapter number 3 that we have discussed in detail. What I need from you, read the chapter again. Solve the questions which are given in the test your knowledge section. Plus, again, you have MTP, RTP, a lot of practice material. Practice that. Very, very important. Practice that, solve the questions, and based on that, if you have any doubts, please bring those doubts in the next lecture. Please bring your doubts in the next lecture so that we can discuss those doubts. Okay, so read the chapter, solve the questions, and bring your doubts. Number 2, with respect to the next lecture, today is 10th of September. We have a next lecture on 13th September, which is Saturday. Okay, we have Saturday, 13th September, a lecture on chapter number 4. We will start with the chapter number 4, that is materiality, risk assessment, and internal controls. I want you guys to read that chapter in detail so that when we will discuss, you should be aware that what is there in that chapter. Basic knowledge. It should not be like, okay, everything is going from above. So please, please, please read this chapter, practice, and read that chapter. Reading and practicing doesn't have any alternative. Okay. If no further doubts, then I propose to keep the session till here, guys. Okay? I'll see you in the next lecture. Thank you, everyone, and good night.
Thank you, sir.
Yes. Thank you. Good night.